It's been 3 years since I started to do managed investing, and now I'm expected to retire with $1.8 million. Here's how. In 2022, I wanted to try more of a hands-off approach to investing. So I have been investing for the past 10 years by myself, choosing all my stocks and all my ETFs. But I decided a few years ago that maybe I should try a more lazy girl approach. So I decided to open up a Wealthsimple Invest account. I started that in February of 2022. It is now February of 2025. And I want to show you how my portfolio has grown. For context, all of this money is in my RRSP. So the RRSP is a registered retirement savings plan. And on Wealthsimple, I chose the managed plan, which basically means a robo-advisor or a robot or algorithm is choosing the investments for you. The goal is that by retirement, I have enough money there to retire and not have to work anymore. Let me know, have you started thinking about your retirement? I feel like a lot of us have not started thinking about it because we're young, but this is the perfect time to start because you have a lot of time for your money to grow. So for my portfolio, I decided to choose, again, managed investing. And for risk level, I chose the risk level 10 out of 10. They basically ask you a bunch of questions about what you want to use the money for, how long you'll be investing for, what your time horizon is, all these different things. And then you choose your risk level. So again, I chose 10 out of 10. Apparently there is level 11 out of 10. And I'm gonna look into this after this video so that for the next time I update you, I can show you how my portfolio has grown at the 11 out of 10 risk level. In this portfolio, there are a bunch of different holdings and the distribution is between US equities, international equities, emerging markets equities, Canadian equities, global equities, government bonds, gold, and cash. If I were personally investing this money by myself, I would choose to not have any money in gold, any money in bonds, and maybe not any global equities. I am a very aggressive investor, meaning the majority of my portfolio would be in US and Canadian equities. But again, this is a more balanced approach and this is a lazy girl investment strategy. So that's why I've been testing it out with you all for the past few years. So it seems really good, right? It seems amazing. Everyone's maybe like, this seems too good to be true. So the catch is that they do charge you fees. And over the past 3 years, I have paid $127.95 in fees. So I would say it's not too bad, but let me show you how the fees work. So here you can see on my screen that I have a number of fees over the past few years, and you can see it gradually increases as we go over time. The reason for that is because there is a percentage-based fee, which is 0.4%. And over the years, as my portfolio has grown, the fees also grow with it. So when you have a small portfolio, the fees don't really matter that much, but the larger your portfolio gets, the more costly it will be. How I've been approaching this is that every single day, on the first day of every month, I have been putting $500 Canadian dollars into this account. And it has been automated. I have not had to change it at all. I've just let it consistently grow since 2022. So now let's go in and look at my process. I'll be sharing my screen so you can see how we've been doing. This is my Wealthsimple Invest managed portfolio. I have put in over the past few years $19,000, which is that $500 per month. So I've been consistent with it. And over the past 3 years, you can see my growth is 26.77%, which is about $5,085.72 that I've seen in growth over the past few years. Here you can see my growth over time and my projected growth by the time I am 65 years old. In 2023, when I made my first update, my growth was expected to be about $857,000 by the time I'm 65. In late 2024, I did another update and it was expected to be about $1.48 million by the time I was 65. And now we're just a few months later. You know, I recorded that in November, now it's February, but we are expected to have about $1.61 million by the time I am 65. So we can see that over time there has been great growth and I really love to see that. Of course, not everybody wants to retire at 65, me included. I would love to retire earlier than that. So you can see what your growth will be if you take your money out a bit earlier. By age 54, it will be $655,000. By age 62, it'll be $1.27 million. And let's say you want to retire even later than that. Don't know why. If you want to retire at age 70, it'll be $2.39 million. So we can see there's definite growth over time. And that's why I really like this, because you can see and project how much you'll have in the future. So in my last few videos, I have just told you what my portfolio growth has been, but this time I thought I would tell you what the portfolio is actually holding. And the reason I'm doing this is because technically, if you wanted to avoid the fee that they charge, you could just buy the ETFs that they're buying instead of like getting them to manage it. So that is what I'm gonna read out for you right now. So in my portfolio right now, I have ZFL, which is the BMO Bond ETF. I also have QCN, which is a McKinsey Canadian Equities ETF. There's EEMV, which is the iShares Emerging Markets ETF. There's also GLOVE, which is a Goldman Sachs Active Beta ETF. I had no idea what this is, but it's basically mid-cap stocks that are in developed markets based on 4 factors, and they choose a bunch of factors to determine what's in that ETF. There's also IEFA, which is the iShares Developed Market ETF. And here they invest in Europe, Australasia, which is Australia and Asia, the Far East, but it excludes North America. And lastly, they have VTI, which is essentially the entire US stock market. So there are different funds within this ETF, and technically, again, you could just purchase all of these funds by yourself and make this balanced portfolio. I'd say the benefit of having them manage it instead of you managing it is that the rebalancing is done for you automatically. So you know you'll always have the right percentage of each of the stocks or each of the ETFs. So the golden question is, would I do this again? I would say yes. Again, I paid about $127 in fees over the past 3 years. It's not that much in the grand scheme of things, and I would say that my portfolio has performed pretty well. I would say if you are a lazy investor and you truly don't want to do the work yourself of picking stocks, rebalancing your portfolio, doing research, this would be a great solution for you. If you're someone who wants to actually do the research to pick your ETFs and pick your stocks, maybe you do individual investing and you do self-directed investing. But again, for the average person, if you are stuck between investing and not investing because of the analysis paralysis that you have about choosing stocks, just go with this option. Another alternative for you all is to put your money in an ETF like the S&P 500, one that tracks the S&P 500. An example of that would be VFV. I have been investing in VFV for the past, I don't know how many years, like 3-4 years, and it has been doing very well. I think it's up 33%. So if I had just put all my money in that one ETF, it would have performed better. However, it's not as balanced, and if the US stock market tanks, well, all your money is going down with it. So that is an option, but again, I can make a video for all of you on my top 4 ETFs, so please let me know if you want to see that. Thank you so much for watching. I hope that you enjoyed this video, and I will see you in the next one. Bye.